Hello and welcome. This is the orientation for the City of Boulder, Colorado's homeownership programs. My name is Eric Swanson. I'm one of the homeownership program coordinators with the City of Boulder, and I'll be conducting this presentation. Some of the things we're going to talk about are the different programs the City of Boulder offers, the requirements for those programs. We'll also talk about owning a permanently affordable home. The permanently affordable program is one of our most popular, so we're going to spend a little bit more time with that. We'll also talk about the team that one works with when they're buying a home. This would be, in most cases, a lender, a realtor, and in this case, the city staff. We'll talk about applying and buying a home through the program and how that process works. And finally, we'll conclude with some frequently asked questions about the program. Now, this orientation is a requirement for people who are applying to the program, and to verify that people have viewed the presentation and understand the information, we require that they complete a test, and this test can be downloaded from the website. Some people will prefer to do that test as they're watching the program, which is perfectly fine. It actually follows the order of the presentation. So if you're someone who thinks that that would be helpful, please pause now and download that so you have it in front of you. Also, because this is a recorded presentation, I can't take questions, obviously. However, if you do have questions that aren't answered in the presentation, please write them down and give us a call or email using the information below, and we'd be happy to answer those questions. Let's start by talking about the programs that the City of Boulder offers. We have 3 programs. The first one is the Permanently Affordable Program. The next one is the Solutions Grant, and finally the Shared Appreciation Loan or House to Home Ownership Program. We'll start with the Permanently Affordable Program. So in this program, these are homes that are sold at below market rate prices, and you can see a list of those homes on our website. The listing will contain the maximum price that the homes can be sold for, and when you compare that to market prices in Boulder, you'll see that they are well below market rates. Now, these homes need to be sold to a buyer that's qualified by the city. There's both income and asset requirements and some other criteria that applicants need to meet. The homes in this program remain affordable in perpetuity. That means one can never buy out of the affordability restrictions. So how these homes remain affordable is that basically the sales price is restricted. First of all, the homes come into the program at below market rate prices. In the City of Boulder, there's an inclusionary housing ordinance which requires any new developments to include a certain percentage of permanently affordable housing. We also cap the appreciation on these homes at somewhere between 1 and 3.5%, so that future buyers, when they purchase, will have a slightly lower price. We also limit credits for improvements and updates that are made to the house, and we also limit sales costs or realtor fees on these homes. Let's next talk about the Solutions Grant. So this is a grant that can be used with the Permanently Affordable Program, the program I just talked about. And in fact, that's primarily what this grant is used with. Thistle Communities in the City of Boulder also has a permanently affordable program, and this grant can be used with their homes as well. But it can't be used on any other homes or market rate homes in the City of Boulder. Now, the grant helps cover up to 5% of the price of the home, and it's designed for people who have very limited savings to help them with the minimum down payment and closing costs that they'll need in order to close on one of the permanently affordable homes. Now, the amount of the grant is dependent on the closing costs and the lender's requirements for down payment. So we will assess those to determine how much of a grant is available. And the grant is designed to cover a gap between what the lender is saying is required to close and what the buyer has available to close. And finally, we won't determine the grant amount until after a contract's been written, so someone's under contract for a house, and we can ascertain what the closing costs are and what the lender requirements are. Here's an example of how this grant might work. Let's say someone is purchasing a home for $100,000 and they're getting a loan for $95,000 or 5% down, and the closing costs are $6,000. So this is what the bank is telling this particular buyer they need to pay for closing costs. So that means the amount that's due at the closing is $11,000, that 5% down plus the closing costs. Now in this scenario, we're saying that the buyer has in their own bank accounts $6,500. So you can see there's a gap there, and that gap is $4,500, and that's that would be the solutions grant that would be awarded to help make this transaction close. Now these grants aren't repaid at all. It's not a loan, it's actually a grant. However, the grant amount is subtracted from the future resale price. And the appreciation that is calculated on the home each year is based on that calculated future resale price. Let's next talk about the shared appreciation loan. This is also referred to as house-to-home ownership, or H2O. And this loan can be used to purchase a market rate home in Boulder. So unlike the other two programs, this is targeted towards market rate purchases. In fact, it can't be used with the other programs or the permanently affordable program. However, like the grant I just talked about, this loan is designed for people who have minimal savings to help them close the gap between what their lender is saying they're required to close and what they have available in their own funds to do that. Now it's a deferred loan for up to 15% of the purchase price, and no payments are made on this loan until 15 years. Or if the home is resold, then it gets paid back. Now properties need to be within the city limits of Boulder, and the home remains market rate when it's sold. So unlike the prior program I talked about, we don't calculate a resale price for this. It's whatever the market will bear. Now when this loan is paid back, one pays back the original loan amount plus 15% of the appreciation. Or if they only took out a 10% loan, it would be 10% of the appreciation, and so on. And here's an example of how this works. In this example, the purchase price of the home was $200,000. The borrower got a 15% loan from us, so $30,000. Then 15 years pass. Again, no payments are made during those 15 years. No interest payments are made or principal. So after that 15 years, the home's appreciated $100,000 in this example. So now the home's worth $300,000. At that point, at this 15-year mark, the owner needs to pay back the loan. So they will pay back the original amount, the $30,000, plus a share of that $100,000 in appreciation, which would, in this case, would be $15,000. So that's $45,000 that's due back. This is a balloon payment. And it's due all at once, either at 15 years or if the home is resold before 15 years, it is due back then. Finally, if the home depreciates over those 15 years, so it's less than this example, less than $200,000, there would not be any share of the appreciation because there is no appreciation. However, still the original loan amount would be due back. So in this case, the $30,000. All right, now let's go on and talk about some of the program requirements. We have income requirements, asset requirements, and other requirements that applicants need to meet. We'll start out with income. Here you can see gross income amounts for the different programs, and you can always see the latest amounts on our website. They're usually updated shortly after the first of the year. You'll also notice that there are two income categories in the permanently affordable program. There's a low to moderate income and a middle income program. And this is for different, we have homes that are targeted at different income levels. Now again, these are the maximums. These are the cap gross incomes. You obviously can earn less than this and still qualify for the program. And when I talk about gross income, what I'm talking about is sort of usually that biggest number that is on the pay stub. This is before taxes are taken out, before money is taken out for benefits, those sorts of things. This is the gross amount. Now, if you are a self-employed person, we look at your net income after expenses have been taken out for the business. And here are a few other income notes. Child care expenses, if they're incurred in order to work, can be deducted from the income. We can also deduct medical expenses if they're more than 3% of the gross income. This doesn't include insurance premiums. This is most likely going to be someone who has a chronic condition that they're receiving ongoing treatment for, that we would be able to deduct that. And finally, we must be able to document all your income. All right, let's next talk about the assets. And when I'm talking about assets, I'm talking about things that are in savings accounts, checking accounts, maybe a stock account, those types of things, CDs, anything that is really cash right now or very easily converted to cash. I'm not talking about instruments or the car one uses to get to work or a baseball card collection or anything like that. We're looking at liquid assets. And you can look at this chart and see that there's a few different categories. Most people are going to fit under A, which is $55,000 is the cap on the assets that one can have. You'll see down there at B, people in the middle income program actually get a little bit higher asset limit. And then there's a few other asset limits depending on what one's situation is. Now, for each additional family member or each additional person in the household, we'll add $15,000 to that asset limit. So for example, if it was a two-person household who was fitting into the low to moderate income program, therefore they would have $55,000 as their starting point, and then we add in that second person, which would add another $15,000, creating a total of $70,000 is their asset cap. And you can add that for each person. And we can exempt some retirement assets depending on a person's age. And the chart there lists the different age groups and how much can be deducted. And when I discuss retirement assets, what I'm talking about here are 401ks, 403bs, IRAs, Roth IRAs, anything that is designated as a retirement account by the federal government generally are things that we will be able to exempt. Now you'll see that note on the bottom that if someone has in excess of these limits, we will count the balance as a regular asset. So for example, say there's a 38-year-old person that has $35,000 in a 401k. Well, we'll be able to deduct $30,000 of that. However, the additional $5,000 will count towards their regular asset cap. And finally, we can exempt from assets some of the money that people are putting down on a home. We can actually exempt up to 20% of the value of the house, assuming that person is putting 20% more down on the house. And at the point of application, we just make an estimate of what this will be, and then when someone goes to close, we make sure that estimate is accurate, or we adjust it to make sure they're still under the asset limits for the program. Now, if someone is 65 years or older, we can actually exempt the full amount that they put down on the home. So if there's someone who's 65 and retired and they're putting down 40% on the home, we'll exempt 40% from their assets. All right, let's talk about some of the other requirements for the programs now. And these are a list of requirements for all the programs I talked about. First of all, one needs to complete the city orientation and complete the full-day homebuyers class. Now, this presentation that you're viewing right now satisfies that orientation requirement. The full-day homebuyers class is actually taught by the city or by the county of Boulder, and there's details on our website in the training section about that class. This homebuyers class can also be taken online. However, there's a $50 fee for that, but some people find that more convenient to take it online. Next, one of the people in the household needs to work at least 30 hours a week, unless, of course, they're retired or permanently disabled. The household is required to bring $2,000 of cash to the deal. The household needs to be able to secure a first mortgage, so that means a lender tells them that they will be able to loan them money or give them a mortgage to buy the house. The total monthly debt to income ratio has to be less than 42%. And what this means is we'll look at the amount of debt that an applicant has. So this might be student debt. Even if it's in deferment, we'll make an estimate. So the monthly payments for student debt, car payments, monthly payments for credit cards, all those types of things. And we'll divide that by the monthly income that we've calculated for an applicant. And that needs to be under 42% in most cases. We sometimes have a little bit of latitude where we can go a little bit above that, but in most cases it needs to be under 42%. Next, a buyer cannot own another home at the time that they close on a home through our program. People who get homes through our program need to own or occupy the properties. Next, the number of bedrooms may only exceed the number in the household by one. So what this means is that a single person could buy a home through our program with up to 2 bedrooms. A 2-person household could buy a home with up to 3 bedrooms, and so on. And finally, there needs to be a work history of at least 1 year in most cases. And this doesn't necessarily have to be a work history with a single employer. We're just looking to see that there is a history of work. Now there's some additional requirements for the H2O program. First of all, and the H2O again is the loan program, the shared appreciation loan program, the third one I talked about. First of all, people must be a first-time home buyer, so that means they can't have owned a home in the last 3 years unless they've been divorced in that time. Applicants for this program must work within the city limits of Boulder, and the home they purchase must also be within the city limits of Boulder. Now, the down payment funds, or the money that we commit to this, we don't actually commit those until we've reviewed the property, the inspection report, the appraisal, and Funding Partners, who is an organization that helps us administer this program, has reviewed the loan application. So we do some due diligence on these properties before we lend money on them. Finally, I sometimes am asked if there's ever exceptions made to any of these requirements. We never make exceptions to the income limits. Even if someone is a few dollars over, we won't be able to find them eligible for the program. We also don't make exceptions for people who are looking at the Shared Appreciation Program or the H2O program. However, we can sometimes make exceptions to some of the other program requirements if there's a justifiable reason. There's a process that we need to take it through where there's a committee and staff weigh in on it. So if there's an applicant that feels like they have a compelling reason why they should be given an exception, please just include that with the application or give us a call and talk through it, and we can see if we think that it is a justifiable thing to take through this exception process. All right, let's next talk about owning a permanently affordable home. This was the first program I talked about. There is a covenant that owners of these homes sign when they close on the homes, and this defines the owner's rights and responsibilities. And some of the things in this covenant are that the appreciation is capped at between 1% and 3.5% annually. There's also limits on the number of capital improvements that can be made and credit that can be given for those items. There's also restrictions on owner occupancy and rental conditions. There are some rental provisions in the covenant, but the owner needs to abide by those. The covenant also talks about who the home can be sold to in the future. Basically, anyone who's been income qualified through our program is eligible to purchase it. The covenant also talks about how much the home can be sold for. There's a formula used to determine what that price is, and so that is prescribed in advance. Also, there's a prescribed way of marketing the homes and a process they need to go through when they are sold. And finally, there are limits on refinancing. In essence, buyers need to maintain a little bit of equity in their home if they're going to refinance. Let's next talk about how the prices on these permanently affordable homes are calculated. So when an owner sells or refinances, we will calculate the value for them, and we actually will send out a letter that shows how that is done, but here's the basic formula. We start with the original affordable price, of course, minus the solutions grant. So when we were talking about that grant above, the original price was $100,000, and the city provided a grant for $450,000. So the starting resale price in that case would be $95,500. We add into that annual appreciation, and that appreciation is somewhere between 1 and 3.5%. And we look at area economic indicators every year to determine what that is. And we also send out a letter every year that lets all our homeowners know what the annual appreciation is on their home. We also add money for capital improvements or upgrades that are made to the property. And here you can see the list of items that are available for credit. And you can see it's a relatively limited list. This is another way that we keep these homes affordable, is by only adding credit for certain upgrades that are made. Now, anyone who makes an upgrade to their house in one of these categories needs to have it pre-approved by us, and that's mostly so we can make sure everyone understands what they're going to get credit for and what they're not going to get credit for. The maximum amount that someone can get credit for over the time that they own the home is $25,000. We also, when we calculate the resale price, will subtract for excessive damage. And when homes are sold, there's an inspection done on them. And if there are items that are damaged and that the owner is not going to fix, we will subtract money out for that. This might be a furnace that is damaged or needs to be cleaned, or maybe there is some tile that needs to be regrouted, or tile that's damaged in the home, or there's damage to carpet or flooring that needs to be repaired. So any of those things that aren't taken care of after the inspection will be deducted from the resale price. We also add in some money for closing costs to help the seller with some of their closing costs. Right now it's at $650. We also will add in some money for a cost to sell the property. If people are using a realtor, it's 2.5%, and that's split between the two realtors, so they'll each get 1.25% of the home's value. Or if someone is selling it by themselves, what they call a for sale by owner, we'll add in a flat marketing fee of $550. And that's how we come up with the maximum resale price for a home. All right, let's next talk about applying for and buying a home in the program. First, we'll talk about getting qualified. The first thing we encourage people to do is get pre-approved for a mortgage. We don't want someone to go shopping for a home and then realize that they can't get a mortgage to buy that home. And again, that debt to income ratio needs to be 42% or less in most cases. The next thing one would want to do is turn in the city application, complete it and turn it in, and that application can be downloaded from our website. There's a page in there that has a checklist of additional documents required, things like taxes, bank statements, some supporting documents that we need in order to process an application. So we want people to go through that checklist and make sure all that is included with their application when they turn it in. Next, attend the orientation, which this is, and then also the home buyers class. We like people to take that home buyers class as soon as they can because it helps greatly in the whole process. And then finally, selecting a realtor and starting to shop for a home. So in this getting qualified section, there are a few people that are mentioned, a few people on the team that are mentioned, people like lenders and realtors. So I'm going to take a little detour and talk about those people now. First, we'll talk about lenders. Now, the city does not provide loans, so buyers need to work with a lender, and we actually do not allow private financing, so that would be friends or family. So buyers need to work with a lender. What a lender can do is they're going to be able to help one determine how much they can afford, so how large a house they can afford. They'll be able to estimate what monthly payments are so people can see how it's going to fit into their budget. They'll also be able to estimate what the closing costs are, so the money that's going to be needed at the closing table in order to close the deal. Lenders also help people evaluate loan products. There's a variety of different loans out there, all suited for different people's needs and requirements. And so lenders are going to be able to look at all those different products and identify which ones will best fit a client. And finally, there's a list of lenders on our website. One does not need to use any of those. People can use whoever they like. However, we provide that list there to help people who might not have a lender or need a starting point. Now, an important thing to note is the lenders on our website have reviewed the covenants attached to these properties and have approved those and said that they can lend on these types of properties. If you're working with a lender that's not on that website or not on our website, sorry, or not familiar with the affordable program, you want to make sure you talk with them early on and let them know that you're thinking about buying in the affordable program, and make sure that the loan products that they're selecting for you will fit with that. I have a copy of the covenant that if you're working with a lender, that you want to send them that so they can vet it and make sure that it will work with their products. We're happy to send that on to them. Let's next talk about realtors. So the City of Boulder does not provide real estate services. In most cases, people will work with a realtor to help them through this process. And the city is really a sort of neutral party in the middle. We can't advocate for buyers or sellers. A realtor is really the one that does that. So we encourage all people to get a realtor. And if you are a buyer of a home, you actually don't need to pay any fees to the realtor. The buyer's realtor is actually paid out of the proceeds of the sale of the house, or paid from the seller's proceeds. Some of the things that a realtor can help one do is schedule showings and help people evaluate the different properties, compare and contrast. They also manage the closing timeline and the tasks that happen during that. After one goes under contract, there's a variety of things that happen, and a realtor helps make sure all of those things are staying on time. Realtors will help negotiate price, repair items, negotiate payment of other costs and closing dates, etc. So there's a variety of points that they can help negotiate. They also develop and review the contracts that actually solidify the deal. Finally, there's a list of realtors on our website. Of course, just like the lenders, one does not need to use any of them. Any realtor will be able to help an applicant out. The realtors on our website do have some familiarity with the program, and sometimes that's a benefit. However, we'll work with any realtor, and we're happy to talk with them about the program and about the slight ways that it's different than a regular transaction. And finally, the city staff. We think of ourselves as being part of the team that helps bring these deals together. Some of the things that are the roles that we play is we get applicants certified for the program. We run lotteries for the homes when they're sold. We also review sales contracts to make sure it meets the city requirements. We'll also review inspection reports that come through as part of the closing process, and will order necessary corrections or repairs based on what the buyer has or what the current owner has agreed to in their covenant. We might require that some of those items be fixed. And finally, we work with the lender and the title company to prepare closing documents related to the city program and get those to the closing to make sure that they're part of the transaction. All right, let's go back to the application and buying process. So after you get qualified, what happens, or after you turn in your application, what happens? You'll get a preliminary certification letter from us, usually within 2 weeks, that says we've reviewed you and certified you for the program. That means that one is now eligible to enter lotteries and to go under contracts on properties within the program. The certification letter is valid for 6 months, and then people need to recertify. Basically, that means we update all the numbers, the income and asset numbers, and there is actually no fee for recertifying, which is very nice. Now, as I mentioned earlier, the city staff help monitor and hold lotteries for these properties, and I'll explain a little bit more about what the lottery process is. All the homes in the program do go through what's called a 30-day open marketing period. During that time, no contracts or offers are made on the property. It's really just a chance for people who are interested in the property to go see it. If they haven't finished up their application, to get it finished up quickly. And then also people who are see the property and are interested during that 30 days, they will also send in a lottery entry form, basically telling us that they're interested and they want to be entered in the lottery for the house. At the end of the 30 days, we hold a lottery to decide who has the first opportunity to make an offer on the house. The person who is first has 24 hours to go under contract on the house. So they need to submit a contract within 24 hours of winning that lottery. Homes that don't go under contract at the lottery, coming out of the lottery, are open and available for anyone who's income qualified to come up and purchase it. And one can see that on our website, looking at all the properties in the permanently affordable program. Some will have lottery dates in them, some will just say available. That means that they've already gone through the lottery process and they're open for any income eligible buyer to come up and make an offer at any time. Now within each lottery, there is some preference given for people who live or work in Boulder. And here is the list of those preference categories. So people who live and work and have actually been income certified for a year have the highest preference in lottery. And then it goes to people who live and work in Boulder and so on down the line. And I think I've got an example here of how that might shake out, or how a lottery would be held. In this example, there's two people, Jim and Jane, who both live and work in Boulder and have been income certified for a year. And so they're actually in the first category, and when the lottery is held, these two would be in the first sort of section of lottery, and they would get positions 1 and 2, depending on how they're drawn. And then the next three people in that next category, the people who live and work in Boulder, you can see there's 3 of them, they would be the next 3 that are drawn. So they would get positions number 3, 4, and 5 in the lottery. And we'd work our way through the list in that fashion, going through these different categories. Now, sometimes people will get discouraged because they feel like they're in category number 5 or 6. They're a little bit further down the list. I'll just remind folks that we do have homes that have already gone through the lottery process without a buyer, and so they're available to any income qualified buyer at that point. And finally, there is some homes that have a minor dependency preference and an accessibility preference, and that will be listed in the home listing so people can see if those preferences apply. All right, finally, let's conclude with some of the frequently asked questions about the program. The first question here, at the time of purchase of an affordable home, can someone own another home or be entitled to another home? No, they cannot. At the time that someone closes on a permanently affordable home, they cannot be on title or own any other home. As I mentioned earlier, you can turn in an application while still being on title to a property, but before one closes on the permanently affordable home, they can no longer own that home. Do I have to work with a realtor? Nope. People do not need to work with a realtor. However, we recommend it. Again, the realtor promotes the buyer's sole interest in the transaction. So we always encourage people to do it, but we do not require it. And the next question is, do I need to work with a lender? The answer to this is yes. A mortgage application and pre-approval letter are required as part of the application process, and all homes that are purchased through our program need to be purchased using an institutional lender. We don't allow private financing, which would be financing from family or friends. The next question is, I'm going through a divorce, should I apply now? We really encourage people that are going through a divorce or a separation to wait until that's been finalized so that we can calculate out the assets and incomes most accurately. And we will want to look at court-ordered divisions of assets and understand any sort of payments or maintenance payments or child support payments that are coming in. The next question is, can I bid more for a house that I really like? With the permanently affordable program, one cannot. Generally, there is a maximum price that the house can be sold for, and it can't be sold for more than that. If someone's buying a market rate house using the house to home ownership or the shared appreciation loan, they can bid whatever their lender has pre-approved them for. So in that case, one can. And finally, can a seller of a permanently affordable home reject an offer? In most cases, they can't, but there are a few reasons for which someone could reject an offer. If it's less than the maximum selling price, the offer could be rejected. If the offer is contingent on the sale of a home that the buyer currently owns, they can reject a contract with that type of contingency. And if the offer wasn't submitted within 24 hours after the lottery, it can also be rejected. All right, well, that concludes this presentation. In order to verify that you have viewed it and completed it and understand the information, there's actually a test that needs to be completed, and that can be downloaded from our website. You'll see it there. So please download that, and you submit it with your application, or if you've already submitted your application, you can send it to us separately via that email address or mail, however you'd like. Again, if you have questions that weren't answered in the presentation, please call us or email us at the number below, and we'd be happy to help you answer any of those questions. Thank you again for your time and for your interest in our program.